Hello. Okay, welcome everyone. I think we're going to get started. So thank you for making the time to join us for this webinar on personal taxes. So we have some good updates for you today, and then we're going to spend some time to go through some tax planning tips as well. So we're going to start with a quick introduction. I'm going to ask my colleague here, Apita, to introduce herself. And then once she's done, I can now introduce myself and then we can get started.
Hello everyone, my name is Arpita Aras. I'm a qualified chartered accountant from India and I have over 10 years of experience in financial reporting and auditing. I I work as a staff accountant at GMS and a team lead in financial reporting as well. I will be completing 1 year with GMS this month, so really excited about
Yes.
that. Um, I'm excited for this webinar.
Okay, awesome, awesome. All right, thank you. Thank you for that. I didn't even realize you're 1 year already at the firm, so that's awesome. Okay, so welcome everyone. My name is Ken Green, one of the partners here at the firm. And so we've been in this business since 2013. Started with my partner, Celia, and now we have other team members as well. So tonight we're going to spend some time talking about personal taxes. And so this is how we'll spend our day this evening. We're going to go through highlights of we'll start with some personal tax foundational concepts, which I think is very important for all of you to know if you really, really want to start saving taxes. And then I'm going to spend some time, Apita will spend some time going through some personal tax updates, particularly all the stuff that is new in for 2025 as we plan and prepare our taxes for 2024. I'm going to go through some personal tax planning tips as well, and then we'll share a few things on how we can help support you in this process, whether it's preparing your taxes, planning to save and to minimize taxes, and any other thing you may require from us. So just give me a minute here. Let me pull up my slide and then we can get started. Okay, so let's go through some foundational concepts. I think it is very, very important for you to have a basic knowledge of how Canadian tax system works. And it's important for you to know that because it helps you in building tax efficient wealth. Anytime I talk about this, the average person often say, well, Ken, I don't have time to learn anything about taxes, or maybe I can't afford to hire a competent accountant to help me. And when I hear these things, I sort of get worried. And the reason I get worried is because these same people oftentimes they get excited when they get a 1% or 2% raise in salaries, but they fail to realize that spending time to understand and to plan your affairs can give you as much as 2x, 3x, even 10x more than what you get in your annual salary increases. So I think it is very, very important to get a good understanding of how our tax system works. Now, what's the basis of tax in Canada? The Canadian tax system is based on residency. Okay, so what that means is if you're a resident in Canada for tax purposes, you're taxed on your worldwide income, right? It doesn't matter where your income is coming from, if your income is coming from Brazil, if your income is coming from the US, from any country for that matter. So long as you're a resident in Canada for tax purposes, you're going to pay Canadian taxes on your worldwide income. Um, to avoid double taxation, what the country has done is that they have foreign tax credits that will give that individuals get, and this will automatically happen. I mean, we do it as part of our tax preparation process. So long as Canada has a tax treaty with a foreign country, then you get tax credits to offset some of those taxes you've paid in a foreign country. Okay. Now let's talk about the marginal tax rate system. So that's what we have in Canada. We have a marginal tax system in Canada. What this means is that the more you make, the more taxes you pay. So it's important for you to know this. It's important for you to know what your marginal tax rate is because this will allow you to manage your brackets and it will allow you to optimize your taxes. Now, the tax rates change from year to year. So here are the rates for 2024. So these are the rates that will be applicable when we file your 2024 taxes. And as you can see, I mentioned earlier about the marginal tax rates. So as you can see, these rates change as you go from certain amount to, so that personal tax amount now is approximately 16,000 now. So if you earn up to $16,000, you don't pay any taxes at all. If you earn anything above that, you're going to pay 20% up to $51,000. And then any additional tax, any additional dollar you earn above $51,000 for 46, you pay 24% on that additional dollar. And it just goes up to the highest bracket that we have there. So you pay 53.53% on any additional income you have higher than 246,752. Okay, so as you can see at the top bracket, at the highest marginal tax rate, you need to be earning over 246,752 for you to trigger that top marginal tax rate. Okay, so very, very important for you to understand this so that this way, when you're planning your taxes, you know how to manage your taxes, you know how to sort of streamline your income so that you can always fall below a certain marginal tax rate if you want to plan that way. So now, how do we calculate our personal taxes? To calculate your personal taxes payable, a tax rate is going to be applied on your taxable income. Okay, so those tax rates we reviewed earlier, those tax rates, they'll take those rates and they will apply that to your taxable income. Ultimately, income tax is based on your taxable income, not your total income or your gross income. Okay, so we use deductions to reduce our total gross income to our taxable income before we now apply the tax rate to determine how much taxes you owe. Okay, and tax payable are further reduced by tax credits, and we're going to talk a little bit about that later. Now, it's important to know that not all income is taxed alike. Okay, in Canada, it matters the type of income that you earn. Okay, it's very, very important. This is because income sources are not equal in the eye of the taxman. Okay, so different types of income attract different tax rates. For example, capital gains, for example, are taxed a little bit lower compared to ordinary income. So it is important to plan in terms of how you earn your income, particularly if you have the flexibility to manage the type of income that you earn. Then now it makes sense for you to consider that, knowing that different tax or different types of income attract different tax rates. Earlier, I talked about tax deductions and tax credits. I think it's important for you to understand the difference, okay, between these two so that you can use them when you're planning and managing your tax liability. Tax deductions will reduce your taxable income, while tax credits will reduce the amount of taxes that you owe. So it's critical that you know which deductions and credits apply to you, which ones you can use when you're filing your tax returns so that you can reduce your overall tax exposure. It's also important to know the difference between tax deferred and tax free. Oftentimes, this is misunderstood. Some people think it's the same thing. Some people don't really quite know the difference. Tax deferral means you will pay the tax liability at a future date. Okay, so you're just deferring the tax from paying it today to sometime in the future. The popular RRSP tool is a good one that we know, right? So when we contribute to our RRSP plan, we get a deduction today. But when we withdraw from that RSP account down the road when we retire, we pay the taxes at that point. Okay, so we're just deferring taxes. Tax-free means you don't have any tax liability. You essentially don't owe any tax. Okay, and a good example for this is the TFSA. So TFSA is the tool we use to save so that the income and the gains that we get in that account will be tax-free. Okay, so always important to understand the difference between tax deferred and tax free. So now I'm gonna pass it on to Apeta, and so she's gonna come back on the stage to talk about some of the new things for this year that applies to you. So take it away.
Yeah, I'm going to share my screen now.
Yeah, so go ahead, share screen.
Can you see my screen?
Um, yeah, okay, so that's you. No, is that you?
Okay.
No, hold on. That is me. Okay, so I think you're good now.
Let's start with what's new for this tax seasons with capital gains. I'm going to talk about the capital inclusion rate first. The capital inclusion rate is basically the portion of your capital gain that is taxable. This rate was originally scheduled to increase from 50% to 66.67% on the 25th of June 2024. However, the federal government has now deferred this increase until 1st of January 2026. This means that all capital gains realized before 1st of January 2026 will be subject to the currently enacted inclusion rate of 50%. CRA is also providing an additional time for taxpayer reporting capital gains to meet their tax filing obligations. It will grant relief of late filing penalties and interest until 2nd of June 2025 for individual filers and until May 1st, 2025 for trust filers. Let's talk about the lifetime capital gain exemption. The lifetime gain exemption is a tax provision that lets small business owners save on taxes on capital gains income up to a certain amount when they sell the shares in their business, a farm property, or a fishing property. Before June 25th, 2024, if you sold a small business, farm, or fishing property, you could avoid paying taxes on the first 1 million of the capital gains. Now that tax free limit has been increased to 1.25 million. This change officially takes effect from the 25th of June 2024, and CRA will continue applying this new limit to the sales made on or after 25th of June 2024. There is also the proposed Canadian Entrepreneurs Incentive. The proposed Canadian Entrepreneurs Incentive provides certain Canadian eligible entrepreneurs with a reduced capital gains inclusion rate for which they sell their business. This measure would apply in addition to any capital gains exemption available, including the lifetime capital gains exemption that we discussed earlier. What does this mean for us? While most people will pay tax on 66.67% of their capital gains from 1st January 2026. But if you are an eligible entrepreneur, you will only have to pay tax on 33.33% of the capital gains, which means you pay less tax. Who qualifies as an eligible? There's a criteria CRA has given for who qualifies as an eligible entrepreneur. We have added that at the end of our presentation under resources. There's a link. You can follow that link. Ultimately, when the Canadian Entrepreneurs Incentive is fully implemented, and the combined increased total lifetime capital gain exemption of 1.25 million, entrepreneurs will benefit from at least 3.25 million in total and partial lifetime capital gains. Alternate minimum tax. We have given the definition of alternate minimum tax is which is an additional income tax imposed under the Income Tax Act on individuals and certain trusts who would otherwise be able to reduce their ordinary Canadian federal income tax through the use of certain deductions, exemptions, or credit. What does this mean? Alternative minimum tax is a special tax rule designed to ensure that high income individuals pay at least a minimum tax amount, even if they use deductions or credits to lower their regular taxes. It is an basically it is an alternative method to calculate the income tax you owe. Under the AMT system, there is a parallel tax calculation that allows fewer deductions, exemptions, and credits that under the then as compared to the regular income tax calculation. What does the increase rate and exemption mean for us? Starting in 2024, the AMT rate has increased from 15% to 20.5%. This means that the people affected by AMT will now pay a higher minimum tax rate. I would like you to know that this AMT is not applicable for everyone, but it is mainly targeted towards high income individuals. We can see this by the increase in basic exemption from 40,000 to 173,000. The calculation for adjusted taxable income has also seen significant changes going forward. The calculation now includes a full-time inclusion of capital gains. Previously, this was up to 80%. Even the limits, there have been placed limits on the value of most refundable credits, uh, tax credits and deductions, meaning you will get fewer deductions and credits under AMT calculation for your taxes. Let's talk about Canada Pension Plan and Employment Insurance contribution. There haven't been any changes in the contribution rate for CPP for 2024 and 2025. The thing that I would like to mention about is the second CPP contribution, which applies at the rate of 4% for your earnings between 68,500 to 73,400. This was introduced in 2024, and most of you would have seen this on your pay stubs for 2024, and will see it on your T4s for 2024. The employment insurance premium rate has seen a marginal decrease in 2025 from that in 2024. Um, from 1.64% to 1.66%, the maximum insurable earnings are set to 65,700, resulting in a maximum annual employee contribution of 1,077.48. Moving on to charitable donations, I'm sure most of you are aware about the extension of deadline. The deadline for making donations for the tax year 2024 was extended to 20th February 2025, given the disruption of the Canada Post strike. The draft legislation has confirmed that the donation can be in cash, transferred by way of a check, credit card, money order, or electronic payment. It is important to note that the extension has currently been provided for the tax year 2024, but you can carry forward the donations, charitable donations deductions, to 2025 as well. Home buyers plan withdrawals. If you are buying your first home, you can borrow from your RRSP tax-free help with the purchase. To help with the purchase, the home buyers plan withdrawal limit has been raised from 35,000 to 60,000 for withdrawals made after 16th of April 2024, assisting first-time home buyers in accessing more funds from their RRSP. It is important to note that you have to repay. You have a time of up to 15 years to repay to your registered RRSP the amount withdrawn. Talking about short-term rentals, if you own a short-term rental property, often used with services like Airbnb or Vrbo, or provide short-term rentals of your principal residence, ensure that you're compliant with municipal and tax township regulations, in addition to complying with your HST obligations. Starting January 1st, 2024, if your rental is non-compliance to these regulations, you will not be eligible to claim expense deductions such as maintenance or utilities on your short-term rental on your taxes. Talking about Canada Child Benefit, if a family was receiving Canada Child Benefit for a child who passed away on or after 1st January 2025, you may remain eligible to receive the Canada Child Benefit payments for an additional of 6 months, or until the date the child would have turned 18, whichever is earlier. The additional 6 months also applies to the child disability benefit. To benefit from this new policy, it is important that the parent or the legal guardian must notify the CRA of the child's death before the end of the following month. Can The Canada Secondary Suit Loan Program, introduced in 2024 Fall Economic Statement, which was updated recently in a news release on the 10th of December 2024, provides homeowners with low interest loans to create secondary suites such as legal basement apartments, laneway suites, garden suites. The program aims to address Canada's housing supply challenges by enabling homeowners to add affordable rental spaces to their programs. In addition to the secondary loan program, suit loan program, homeowners will also be able to refinance the insured mortgage to help cover the cost of adding a secondary suit starting January 15, 2025. Specifically, lenders and insurance will begin allowing mortgage refinancing of up to 90% of the post renovation value of their home, up to a maximum of $2 million, dollars, amortized over a period of 30 years. Homeowners will be able to make use of both the loan program and the mortgage refinancing to help cover the cost of adding a secondary unit. Let's talk about automatic filing of taxes. CRA offers several automatic filing services to reduce filing barriers, especially for low income individuals. One of these would be Simple File by Phone. This was previously known as File My Return option. This is a free and secure service that allows eligible individuals to file their income tax and benefit return over the phone. If you are invited to use this service, please note this is an by invitation service only. You will answer a series of simple questions over the phone. There is no need to fill out a form or do any calculations on your own. Talking about Autofile My Return service, this is a secure online service that automatically fills in parts of your tax return with information that CRA already has. Using certified tax softwares, you can use or you can access this service to retrieve and import your tax information directly into your return, reducing errors and saving times. Who can use this service? Individuals who are trying to file their own returns, or even your authorized representatives, such as GMS, to access to the CRA's online services. I'd also like to bring to your attention that CRA's NetFile service will open on the 24th of Feb 2025. Those who have filed their 2023 tax return on paper will receive the 2024 income tax package from CRA by the 23rd of Feb 2025. Let's talk about the CRA scam updates. CRA has issued guidelines on their website on how to recognize a scam. We have provided resource link in our at the end of our presentation as well. But let me run you through some of the warning signs that CRA has specified on their website. CRA has mentioned that they will not uh, contact you via text messages or ask for refunds by e-transfer. They will also never demand or pressure immediate payment by Interacts, cryptocurrency, prepaid cards, gift cards, threaten to deport you or arrest you or put you in prison, use aggressive or threatening language, set up an in-person meeting in public location to collect a payment. They, under their why CRA may contact you section, they have specified that they will only contact you via telephone or automated messages, via a letter or by email. And this can be done for maybe if they're trying to reach you to remind you to file your tax returns, remind you about your taxes owed, inform you regarding your tax return is if your tax return is being reviewed, your HST or GST return is being reviewed, if an audit process is being initiated. The CRA may call you using an automated telephone message to in as a courtesy reminder to inform you to file your income tax return, pay taxes uh, in quarterly installments, reminding you of your filing payment deadlines. The CRA only sends text messages for multi-factor authentication for all of its sign-in services. If you have enrolled with the telephone option, the CRA will not use text messages or instant messaging services such as Facebook, WhatsApp, etc. CRA has also provided a list of 15 odd scams, the latest updated scams going on, to warn you about these. Some of these includes the that CRA is offering a fraudulent Interact deposit. I'm sure some of you may have already received such messages. Then there's an ongoing scam about low income senior scam, wherein you get a text message to register on a link to receive a benefit if you're a low income earning senior citizen. There's no such rebate that CRA is providing via text messages. I would suggest you to go through the link that we have provided at the end of this presentation. Talking about the Student Loan Forgiveness Program, this program is aimed at increasing healthcare services in designated rural and remote regions across Canada while enabling health professionals to reduce amounts owing on their outstanding Canada students' loan balances. Doctors and the amendment to the definition of the underserved rural or remote community has been is one of the changes that has happened to this program. The doctors and nurses working in the communities of 30,000 or fewer are now eligible for Canada student loan forgiveness. This means that doctors and nurses working in over 200 new communities qualify for this benefit. Family physicians, family medicine residents in these communities are now eligible for up to 60,000 in loan forgiveness over 5 years, and a nurse or nurse practitioner is eligible for up to 30,000 in loan forgiveness over 5 years. The expansion also, as shown on the presentation, the expansion also includes early childhood educators now, dentists, dental hygienists, pharmacists, midwives, teachers, social workers, personal support workers, physiotherapists, and psychologists. I'm not now going to talk about the first home savings account and disability credit. These are not essentially new for this tax season. They have been updated since 2023. They came into effect in 2023 or before that, but I want to talk about them because they are relatively new. The first home savings account is a savings plan designed to help first-time home buyers save money for a down payment. The money you put into your FHSA reduces your tax income just like your RRSP contributions, except when you transfer money from your RRSP to your FHSA. That is not tax deductible. When you withdraw money to buy a home, you don't pay any taxes. When you withdraw money to buy a home, it's called as qualified withdrawal. The limits, you can contribute up to 8,000 per year with a lifetime limit of 40,000. If you don't use the full limit of 8,000 in a year, you can carry it forward up to a maximum of 8,000 per year. To open an FHSA account, you must be 18 or older and a first time home buyer, meaning you haven't owned a home in the past 4 years. The disability tax credit. As of February 2025, the Canada Revenue Agency has implemented several updates to the disability tax credit to enhance accessibility and streamline the application process. In June 2023, CRA introduced a fully digital application system for the DTC. Applicants can now complete Part A of the application online through the CRA's My Account portal, and after completing their section, they receive a reference number to provide to their medical practitioner, who can then complete the Part B. This digital process aims to simplify and expedite applications. It is important to note that medical practitioner certificate is important when you're applying for DTC. With effective August 2022, the CRA has broadened the DTC eligibility requirements, particularly concerning mental health functions, life-sustaining therapy. Notable changes include an expanded list of mental health functions necessary for everyday life, recognition of more activities in determining time spent on life-sustaining therapy, and reduction in the required frequency to at least 2 times per week, totaling 14 hours. Individuals diagnosed with type 1 diabetes are now automatically considered to meet the criteria of life sustaining therapy retroactive to January 1, 2021. I would also like to bring to your attention that if you haven't already, if you were eligible to claim DTC in earlier years, but you haven't applied for it, you can claim it retrospectively up to 10 years. if you if you are eligible for the DTC in the past years but did not claim it, you may be able to claim it back for up to 10 years. If you did not check the box on your DTT application form asking CRA to adjust your previous returns, you may either ask CRA in writing or adjust your previous returns yourself online. If you tick the box, CRA adjusts it for you online by themselves. The DTC amounts for 2024 tax year for eligible person of 18 years of age or older is 9,872, and for people under the age of 18 is 15,630. Your maximum RRSP contribution limit for 2024 is 18% of your total earned income from the previous year, or 31,560, whichever is lower, plus your unused contribution room from your previous years. It is expected to the maximum contribution limit is expected to increase to 34,490 for 2025. The annual TSA contribution limit has increased by $500. So the current annual contribution limit is $7,000, allowing individuals to contribute up to a cumulative limit of 95,000 in 2024 and a cumulative limit of 102,000 in 2025. These are the important timelines this tax season. So these are all your payment due dates and your filing due dates. Please notice that the payment due dates under any personal tax filing and your HST return is 30th April for everybody. Your T1 filing date is 30th April. If you're a sole proprietor, your T1 filing date would be 15th of June. And so your HST filing return date would also be 15th of June. There are no changes in these dates. These are the same as last year. I would now like to ask Ken to join and continue with his presentation.
All right, thank you so much. That was so detailed. So now we've gone through a lot of all the updates, and we don't expect you guys to know all of this, and that's why we've provided a lot of links as well, in case you want to read and spend some time to go through those. As part of our process for filing personal taxes, we have a questionnaire that we'll go through, particularly for new clients that are filing with us for the first time. And so with those questionnaire, we are able to identify some of the things that may be applicable to you. So for those of you that are considering using us for your tax filing, yeah, let us know. We'll have more information on that here as well. Okay, so now let's talk about tax planning. Right, so it's one thing to know some of the rules that apply for personal taxes, is yet another thing to plan, to intentionally plan to save taxes. And so this is one of the things we do here at GMS. We are not just here for compliance, we are here to make sure that you're paying the least amount of taxes. You're not paying anything more than you need to pay. And so that's why I like to talk about planning ideas with taxes. So why is this important? What exactly is tax planning? Well, tax planning is an intentional plan designed to minimize or eliminate taxes. And the way I see it is that an efficient tax plan seeks to accomplish one of three things. First, it seeks to save money tax-free or tax efficiently. Secondly, it seeks to grow your money tax-free or tax efficiently. And finally, it seeks to distribute your money tax-free or tax efficiently. Tax-free sometimes can be challenging, but it's not impossible, right? So with planning, with intention, you can accomplish some of these tax savings when it comes to planning your affairs. So here are some of the things we want to talk about. The first thing is to get organized, right? It's very, very important to get organized as you prepare to file your personal taxes. So for us, we're going to start that process next month. And so you have a few days, maybe, I don't know, 10, 15 days to get all your documents organized, right? So if you're still using papers, then get folders and put them and organize everything. Get a checklist of some of the things that may potentially apply to you. If you sign up with us, we have a checklist. I think our detailed questionnaire that we'll go through is a very comprehensive checklist that we'll provide to all our clients, so that way there is no chance that you're going to miss anything that may apply to you. We also advise you to file on time. It's so important to file on time so that you can avoid penalties and interest. CRA, they determine the interest on a quarterly basis using what they call prescribed rates. Right now, that interest is about 8%, and they compound it every day. Right, so interest can grow very, very quickly if you're not paying your taxes. And one reasons why some people don't pay taxes is because they don't even know how much they're owing. And so that's why it's important to file on time and make sure that you pay those taxes. Secondly, if you file on time, you will potentially avoid reviews and audits. You potentially avoid reassessments because if you're organized, there's less chance of you making mistakes in your filing. And so oftentimes is mistakes, is avoidable errors that sometimes potentially lead to reassessments. So you want to avoid reviews, you want to avoid audits, you want to avoid reassessment as much as you can, because sometimes those things will not only cost you money, sometimes they cost you time, right, to prepare for all of these things. These are some of the things you want to consider as well. We talked about deductions earlier. As I mentioned earlier, I said deductions will help you reduce your taxable income. So here I've highlighted a few examples of some common deductions that you may consider as you begin to prepare to file your 2024 tax returns. The popular ones is the RRSP deduction. So with RRSP contribution, you can essentially reduce your taxable amount so that way you can lower your tax liability. For those of you that have family members that are disabled, then there is also the Registered Disability Savings Benefits Plan. Peter talked earlier about the FHSA, the First Home Savings Account. All these accounts will allow you to reduce your taxable income. There is the childcare expenses. If you have children, there are certain limits that apply, obviously, but childcare expenses deductible, and that will help you reduce your taxable income. Things like disability support, things like moving expenses. If you're moving from one city to another for work purposes, you can deduct your moving expenses. Support payment, employment expenses. If you're a pastor, if you're a clergy person, then there's a clergy residence deduction, which can be significant in some cases. We also have current charges and interest payment. And so remember, when you borrow money to do business, you borrow money to invest, remember that the interest you're paying on the borrowed money is deductible for tax purposes. Always remember, so make sure you're keeping records, particularly if you're investing and maybe you're buying real estate, you're buying something else, you're investing in a business. Any money you borrow to invest, the interest expense on that money is deductible for tax purposes. If you run a business, particularly if you run a sole proprietorship business, then you have to prepare a business schedule. Oftentimes, if you're starting that business, then it's very likely you may have expenses that you can deduct. And if you're not in a position where you have a lot of income, you may end up with a loss. And if you run a business and you have a loss, that loss can be applied against other sources of income and ultimately help you reduce the amount of taxes you owe. Again, if you also have rental properties, there's going to be a rental schedule that you have to complete. And with rental property, you always have to remember there are expenses associated with rental properties. There was a video I did online, and I'm going to share a link to our YouTube video. We post a lot of resources there. And in that video, I did talk about key expenses to remember for your rental properties. Important because you don't want to miss any of those expenses. If you have a vehicle and you use your vehicle to generate income, then a certain portion of that vehicle cost can be deducted, the portion that relates to you running your business or generating income. So always important to know those deductions. Again, deductions will help you reduce your taxable income, and so it's important you don't miss those deductions. Credits, I talked about credits earlier. So credits will help you reduce your taxes payable. So remember, you take deductions to reduce your gross income to taxable income. We apply the tax rate to determine how much taxes you owe. And now you can use tax credit to now offset some of those taxes to come down to exactly what you're owing. Eventually. And so there are a couple of examples here that I put on the slides for you. If you subscribe to a digital news subscription, then yes, that will qualify up to a maximum of $500. There's a Canada training credits that you can use to reduce if you pay money to go to school, additional school or higher education, then yes, you get that credit, and we accumulate this credit every year, $250. Donations, obviously, some of you know this if you make donations, and this year is a special year where you can donate in January and February and use those donations to get a credit for your 2024 tax returns. Medical expenses, first-time home buyers credit. If you're buying a home for the first time, there is a credit that you get. There is a multi-generational home renovation tax credit. If you're renovating your home and you're getting your seniors and your parents to live in the home, then yes, you qualify for a credit. There are other ones like eligible school supply credits and disability tax credit that Peter talked about earlier. Now, there are other things that you can do. We talked about TFSA, right? So why TFSA is not deductible for tax purposes, you can use it as a way to grow money tax-free. So remember, the funds that you take and put in your TFSA account can earn interest income, they can earn dividend income, they can earn capital gains. All of those will be tax-free. Okay, so this is an important tool for saving money, is an important tool for long-term planning as well, for retirement. So I always encourage you to use TFSA. It is a tax-free tool, and so we encourage all our clients to use anything that they can use to save or minimize taxes. We talked about RSP earlier. Important to use that, particularly if you're on the high end, earning high income. Again, you at the end of the day, you still have to watch your total RRSP balance, because you don't want to be in a position where you will get to your retirement and now you're paying a lot of taxes. As you know, tax rates are likely going to increase. It's very unlikely that they will reduce, so they will increase over time. So you got to be strategic with the use of your RRSP vehicle and when you're planning for retirement. And so that's something that we teach as well, and will help you plan along those lines. If you run a business, again, running a business can be a good tool for tax planning. And the whole idea of running a business is to try to run what I call a lifestyle business, so that way you can convert as many of your after tax expenses, and you can convert them to before tax expenses. So remember, if you're just a regular salaried employee, everything you pay, all your expenses are after tax. Okay, but if you run a business, some of those after tax expenses may potentially become expenses you deduct before you apply tax rates and determine your taxes. So that's why business sometimes is key. Consider splitting income with family members, particularly if you have family members in lower tax brackets compared to where you are. There may be opportunities for you to split income. If you're a senior earning pension income, then there is a popular one for the pension income split that you can apply to your pensions. And where possible, if you have securities that have accumulated a lot of gains, you can contribute those securities to charities, to registered charities, and get deduction for the full market value of those securities. And so that can be huge as well. I always talk about real estate because I'm biased towards real estate. I think real estate are fantastic vehicles for saving money. They're fantastic vehicles for planning, particularly tax efficient planning. So if you don't own a home, I highly, highly encourage you to get one. I know for those of you that live in the GTA, I know it's so expensive to own a home in the GTA, but again, the tax benefits are huge. So if you can get into home ownership, I highly, highly encourage you to get one. The proceeds are tax-free when you sell your home. That is huge, right? Given the fact that home prices will potentially go up over time, you can leverage it to get into more real estate, to buy a second home, to buy a rental property. So very, very important in terms of that aspect. You can use it for long-term planning, for retirement. A lot of Canadians use their home as part of their retirement plan. And they do that for a reason, because of these tax benefits. And we know that over time, there is a long-term guaranteed growth growth when it comes to real estate. And if you can, own a couple of rental properties as well. And then by that way, you automatically get into the business of managing rental properties, into the business of managing real estate assets. Okay, very, very important, because now you can get business write-offs, you get leverage, as I talked about earlier. There is long-term growth potential, and it is a very, very efficient vehicle when it comes to tax planning. So real estate, I mean, I talk about it all the time. I guess biased about real estate. If you're an employee, remember that you can renegotiate the terms of your employment. There are lots and lots of benefits that most employees never take advantage of. In fact, some employers don't even know that those benefits exist. So in this article, I share 7 ways you can lower your taxes as an employee. So consider maybe there are things there you can bring up to your employer and have that conversation. I mean, at the end of the day, a lot of them are not that significant, but again, by the time you take a couple and add them together, it begins to add up. We talked about the first home savings plan. Peter went through that earlier, and she also went through the home buyers plan. So these are things you can use to help you get into your home, as I talked about earlier. Earlier in the presentation, I talked about our marginal tax system in Canada, right? So you can use that. I think it's important for you to understand where you fall when it comes to your taxes, to understand your marginal tax rate or the highest marginal taxes you're paying on your income. So when we file your taxes for you, this is one of the conversations we have when we when we talk about the tax plan, so that you understand where you fall and then maybe consider things you can do to fall below your current brackets. Because once you fall below your current brackets, there's potential of saving taxes. So we can help you, obviously, if you want help with your personal taxes. So if you go to our website, you'll find here. So these are the ways we can help you with your personal taxes. Our tax filing fees start from $275 for tax return, and depending on the plan that you have, you can go with our standard plan or the premium plan. So if you go to gmscpa.ca /T1, you'll get more information on these services. What else do I have here? Okay, hold on. I think I have one more slide. And for those of you that are looking to save more on taxes, I have a membership called Tax Efficient Wealth membership group. And so there's something you can also consider. So for this one, if you go to taxefficientwealth.ca, you'll find more information on this. And we mentioned some resources here for you. So for those of you that don't have this book, this is the book that gives you a lot of foundation on taxes and some of the things you can do to start building tax efficient wealth. And so if you click on that link there, you can get a free ebook that you can read. It's a small book. Maybe in 2 hours you should be done reading the book. But again, very insightful for those of you that are fairly new to our Canadian tax system and looking for ways to save tax on a tax efficient way. These are some of the links that Peter mentioned earlier in her presentation. So we've put them here, and we're going to share this link with you later. Sorry, these slides for those of you that are registered. And so these links are clickable. You can click on them to go to learn more about some of the things we talked about today. And for those of you that are looking to learn more about taxes, we post a lot of updates on our YouTube channel. So I invite you to check it out. Subscribe, follow us, turn on the notification button so that as we post new updates, you can get them as soon as they're up and running. For personal tax returns, if you go to our website on that link, you will learn more about our personal tax services. I talked about our tax efficient wealth membership. For those of you that are Instagram or LinkedIn, yeah, you can follow me because I post a lot of updates from time to time on those platforms as well. And that is our office address. We're handling the office. If you want to meet in the office, let me know. We can always arrange to meet you at the office. And the best way to get a hold of us is to contact us by email. And there you have my personal email address, you have Peter's email address, and this is the rest of my team. All of us. So as I always say, these ladies, they make me look good. And so I'm so lucky to have them. They're talented, and they make us do all the good work that we do for our clients. Um, I think that is all. So for those of you that have corporations, next week we're going to be running our webinar on corporate taxes. So if that's something that is going to be of interest to you, just keep your eye out for that information. We're going to be posting it in the coming days. Okay, so now we're going to take some questions. Um, I'm going to go to the comment section. So if you have questions, you can put them in the comment section, and then we can take your questions. So let me check to see if there is any. Can we please get a copy of the questionnaire for both personal and sole proprietorship? Yes. So typically we provide that to all our clients, and yes, we're going to provide that to you. If you're our client, that is one of the ways we onboard you onto our firm. If you want to help us, if you want to engage, justify your personal taxes, yes, we'll give you that, and that will have all the details that you need. If you have two or more rental properties, what can you expense apart from renovation expenses? Can you pay yourself a property management fee? Again, it depends on how you're set up. Okay, so if you have rental properties in your name, let's say for example you have rental properties in your name and you manage those rental properties. Remember, you're going to report that in a schedule in your personal tax return. Okay, so if you want to pay yourself a property management fee, you can do that. Nothing stops you from doing that, but I don't think it makes sense because you will deduct it on your schedule and then you add the income on a different schedule, right? So at the end of the day, is in and out. Okay. But if you have a different structure, so let's say you have a corporate structure that holds all your real estate properties, then yes, your corporation can pay you as a property manager managing the properties for the corporation. Okay, and again, these things can be a little bit of advanced strategies, and so with real estate, depending on your plans for the rental properties, depending on how many properties you own, we can always talk about tax planning strategies, whether it makes sense for you to hold those rental properties in your corporation or to even hold them personally in your name. Okay. And so that is it with rental properties. And then for so your other question in terms of the expenses you can deduct. So I'm just going to take you to our YouTube channel. Let me see if I can find it here. So I did post, so there's a video that I did recently and I posted on that channel. So I'm going to suggest that you go to our channel, see if you can find that video. Where is our videos? Okay. See if you can find that video and then go click on it, and that video will give you a lot of information on expenses that you should consider for personal taxes. So it's right here. So taxation. Okay, so I have two videos actually. So there's one that talks about taxation of rental property in Canada. So if you want to learn anything about how rental properties are taxed in Canada, so you come to this one here, taxation of rental properties in Canada. So this will give you detailed information on how rental properties are taxed in Canada. Then in this other video here, I have the key expenses to track for your rental property. Okay. And so there's a link on our YouTube, on this presentation slides, on our YouTube channel, that you can go and get that information. And our YouTube channel, I think, is easy to get to. So just go to youtube.com/GMS LLP, and then you get to our channel. And there you'll find all the videos and all the updates that we have. Okay, thank you for that. That was a good question. Okay, so I don't see any more questions here. So,
Um,
all right. So, Peter, any closing
there
remarks?
No, there is one
Oh,
more question.
there is? Oh, okay. Okay, yeah, so there's a question here. How do we use gifts to reduce tax liabilities? Also, if we give gift cards to our family and friends, will that fly in the eyes of Siri? Peter, do you want to take this one?
You can't gift money to someone to reduce your taxable income, like to your family and friends. Only gifts made to registered charity can be claimed as a deduction on your tax return. You can give money to your spouse or child. So you can contribute to the RRSP and or FHSA, and the contributor gets the tax deduction. So
Mhm.
that is one way you can gift uh, money to your spouse and your children by contributing to their RRSP or FHSA account and claim that as a deduction.
That's right, and that's a good point because now, because remember, with tax planning, you're planning as a family unit, right? And that's one of the things we consider. So, if you come to us as a new client to our firm, one of the things we want to know is to say, okay, what are the relationships you have? Okay, those relationships can be with other family members, maybe parents, it may be spouse, it may be your children. The relationships may also be business relationships. It may be the businesses that you own, the corporations that you run, the trust that you have. All of those relationships, at the end of the day, the more relationship you have, the more potential you have to save taxes. And so that's how our tax system is kind of biased towards people that have relationships. And so that's why I like to tell my single friends, I say, if you're single, go get married, because that's one way you can save taxes. But if you don't want to get married, then get into other types of relationship like owning corporations and setting up trust and doing things like that, because the tax system in Canada is sort of biased towards people that have relationships. And so earlier I talked about income splitting. And so that's something you can do when you have these relationships, because now you have the ability to split income and to do it strategically so that way the tax liability for the family unit can be reduced. But that's a good question. Yes, gifts, deductible. Sorry, you get a credit when you donate to registered charitable organizations in Canada. And then you talked about gift cards. So gift cards will only be deductible if they have a business purpose. Okay, so there has to be a business purpose when you're giving gift cards. And oftentimes there is a lot of detailed documentation you have to do, particularly with gift cards, because CRA sometimes they require a lot of detailed documentation to support expenses when it comes to gift cards. Okay, any more questions? All right, so I think we're going to end the presentation here. I'm just going to put in the comments the YouTube link. So you guys, for those of you that are still here, you can click on it and then bookmark it. So if you go to the YouTube, I encourage you to subscribe. Follow us. We're going to be posting more and more videos there. And in fact, this replay will likely be posted there as well. Okay, any closing remarks, Peter, before we wrap it up?
No, we will talk. We will share the personal tax questionnaire soon with all of our clients. And if you're interested, please contact us so we can help you file your 2024 tax returns.
Okay, awesome. All right, I want to thank you again for your time this evening. Enjoy the rest of your evening. Bye, everyone.
Bye. Thank you for joining us.